Well, today, Ottawa has called up executives from Canada's largest grocery companies to meet with the Industry Minister, François-Philippe Champagne, scheduled to happen in about 45 minutes time after Prime Minister Justin Trudeau took aim at corporate Canada last week as inflation continues to sink his popularity. We're going to talk about this. We've still got Dan Rohinton on the desk, part of IA Investment Management. But let's talk about how we got here, what Ottawa hopes to extract. We've got Bloomberg's Brian Platt here. Brian, walk us through kind of the tone, the tenor, and what ultimately could come out of this.
Well, the key thing to keep in mind here is that today's the return of Parliament. Parliament's been off since June. It's been a very rough summer for the Liberals. Their polling numbers are way down, and I think they are extremely well aware that this is going to be a tough fall for them in Parliament. They're going to get hammered every day by the Conservatives over the cost of living. And when you think about the way, most people are being affected by the cost of living right now, of course, anybody with a mortgage, anybody with a lot of debt is being hurt by high interest rates. But every single day, people buying groceries are feeling food inflation. And food inflation has been one of the toughest parts of the inflation battle. And so this is all part of a political plan here for Prime Minister Justin Trudeau and the rest of his cabinet and the rest of his party to say, we are aware this is a problem, we're trying to do something about it. So they've called this meeting today with grocers with the goal of stabilizing food prices. And if that sounds vague to you, I think it is very vague. It's not totally clear to me what could come out of this meeting, but that is the bigger political picture here.
I mean, I guess they would point to so many things that are out of their control, even, oil, higher oil prices, ultimately feeding into higher food prices. One thing that has often been bandied about, though, is doing something about competition. But I wonder if that's sort of like closing the barn door after the horse has already left.
Yeah, so the Competition Act changes announced last week. It was on the final day of the cabinet retreat. This is a longer term, well, medium term to longer term fix, right? Is to try to toughen up the enforcement of our competition laws to address, and there's all kinds of sectors that this could address, right? So you could think of many sectors in the Canadian economy that are dominated by just a handful of very large companies. Groceries is one of them, telecom, airlines, many other areas. And so, some of the changes that Trudeau announced, which will have to come forward in legislation and we'll see the details, but it has to do with compelling these companies to give more information so the government can conduct market studies, reducing some of the defenses they can use when they want to merge with other companies. These things could, it's kind of an interesting move, and I think I've talked to people who have different opinions about how substantive these are, but over the medium to longer term, those could potentially make, lower prices in some of these sectors by making them more competitive. In the short term, as you say, it's hard. The government has limited tools it can rely on, and I guess we'll see when this meeting ends later probably early afternoon, what Industry Minister François-Philippe Champagne, what he says came out of their discussions.
Tomorrow we're going to get a read of inflation, and food inflation has been kind of the more stubborn part of it. But inflation is sort of a comparison year over year. I wonder if those comparisons start to get easier and the problem sort of takes care of itself. Though it might not feel that way to Canadians, they might be able to point to numbers and say, oh, look, it's not that bad anymore.
I mean, this government really, really wants to see interest rates coming back down. The elevated interest rates are hammering. I think it's a big reason why the government is sinking in the polls right now. Every single month, more and more Canadians are having to renew their mortgages at much higher rates, most likely than what they had before. And so, the government really wants to see economic numbers coming in that will allow the Bank of Canada to lower interest rates. But interest rates may stay sticky around 3% for a while, right? We'll find out tomorrow maybe how things are trending. But the government, again, aside from trying to control its own fiscal spending, which it doesn't have a great track record of doing, there's not really a whole lot it can do about that right now. So it's searching around to find ways that can show Canadians it's paying attention to this cost of living crisis, crisis, problems, however you want to phrase it. And so this grocery meeting is one of the ways that it's trying to do that in the short term.
All right, Brian, thank you so much for setting up those issues for us. That's Bloomberg's Brian Platt joining us. I want to bring Dan Rohinton back into the conversation. Dan, when you look at shares of Loblaw, Metro, I mean, these were pandemic darlings that did not give up their post-pandemic or their pandemic gains. You know, in most cases, they're still elevated, though they've been kind of flatlining recently. How big of a risk is this extra scrutiny by Ottawa if you're an investor in the sector?
I think it's something to probably leave in the camp of grandstanding more likely than not, because it's not really the grocery stores that are playing a big role in this conversation. Their margins are, the margin give back that they could even give is maybe a quarter a month of what the inflation has been. So this is all grandstanding, political theater, if you will. Realistically, there's not much that can be done on anyone's part because it's really the raw materials that have really gone up. But I will say that food inflation is great for the grocers because if prices are going up 10%, their gross profits are going up 10% because they just follow in line with inflation. So there's more dollars coming through, even if it's the same percentage as before. So it is going to be a headwind, but it's really not related to what's going on in Ottawa right now.
I want to bring that up as a risk because most of these grocers, when they report their food sales, it has not been as high as inflation. So they haven't been able to capture sort of the headline inflation rate. They've also been pretty quick to point out, to your point, that the margins in some cases are outright deteriorating. And they're doing it because they want to not look like they're profiting is so-called greedflation. But if you're an investor, you're looking at the sector that's not keeping up with the price of food and is unable to manage that through their margins, why do you still want to own them?
Because they're defensive companies as a whole in the Canadian context of the market. So if you have to own global stock, or if you can own global stocks, and this is not a conversation that's relevant to you, but if you're a Canada-focused investor, there's very few truly defensive cash flowing companies in the way that the grocers are, the midstream companies can be at periods of time, and the utilities. So it's really a scarcity that allows you to maintain the valuations in the Canadian grocers. But I'd agree with you. The risk reward is mostly balanced because there are more headwinds than tailwinds building. It's just in the context of defense, it's one of the few places to go.
You know, at a time where inflation is a major touch point today, and we're talking about it increasing on the energy side, we're talking about pain at the grocery store. I do want to point out last week's data point. This was a U.S. data point, but it was University of Michigan expectations of inflation. Those are going down. And so much of this game is managing inflation expectations. And by all accounts, when you look at where we are in the interest rate hiking cycle, the consensus is maybe we've got one more left to go. But that it seems like the balance is being struck.
It's really about the length of where the current rate regime stays, because it's really not related to food inflation and some of the really super core inflation drivers. It's about big ticket capital purchases. Think of your cars, your homes, that interest rates affect. So a lot of what's going on here is global agricultural markets, global feedstock. So this is the part of inflation that's very tough to basically put on a leash. But the Bank of Canada and the interest rate regime is trying to slow down other parts of the economy to, in aggregate, hopefully get things under more control than they have been. Consumers have front-run that expectation, but consumer surveys can be volatile. So if this goes on for a year or two, which I don't think is the base case even in our minds, you could see those surveys ticking back up.